People say all the time that folks in my generation, meaning we got in the real estate game after 2008, they say all the time that folks in my generation, we think that real estate values only go up. We don't know what true pain is. And since we haven't lived through the recession, the great real estate crisis of 2008, we don't know how to manage risk. And I'll tell you, that's not true. I've done a ton of studying on managing risk in real estate, and I think we have our portfolio set up pretty well. In this episode, I'm going to talk about a couple things that we've done and a couple things that maybe you can do to manage risk. So first things first, there are levers in real estate that are in your control, and there are levers in real estate that are outside of your control. Outside of your control levers include, hey, when are the supplies going to show up on site? How much are they going to cost when it's finally time to lock in the payment that we're having to pay for this construction? What are interest rates going to be when we need to refinance? What are interest rates going to be for the buyer who's going to buy my asset 5 years from now, like I have projected? What's going to happen to rents? You can control that a little bit. What's going to happen to my expenses? You can control that a little bit. And what is somebody else going to pay for my asset? That's something that none of us can control. What somebody else is willing to pay in relation to our profitability. What is somebody else willing to pay for our assets? Those are all things that are outside of my control. So what I do in my portfolio is I focus on minimizing the things outside of my control that I need to go right. I can't control interest rates. I can't control cap rates, and I can't control what somebody else is willing to pay for my asset. How can I minimize the effect of those while maximizing the things that I can control, like my operations, the deal that I buy, how we structure the deal, and so on. So I'm going to talk about a couple things that we're doing inside of our portfolio to minimize risk. And I'll tell you that this is a little bit easier said than done. We have gotten very, very lucky in the self-storage market. We've got some tremendous tailwinds. Rent growth is up 25% year over year in my portfolio based on last year. And we have a really, really good business behind us, and we have a machine built to find really good deals. So this is not really something that I would say is achievable for everybody in every asset class, but there are some investors that do it really, really well. This is also something that you should think about maybe if you're considering investing in a deal with somebody else, with a sponsor. Hey, what are they assuming? What assumptions are they making, and how much of that is in their control and how much of it isn't? What are they projecting revenue to go up, and what are they projecting it to be? We looked at a memo a couple hours ago from a competitor of ours who's buying massive amounts of storage, just getting super aggressive. They sent out an OM. They're buying an asset for $45 million. They're projecting 25% year one revenue growth, 17% growth year two. They're projecting a 29% expense ratio, whereas we underwrite a 35 or 40% expense ratio in all the deals that we do. And they have full-time managers on site while we don't. I think it's going to be very hard for them to hit those projections, but alas, who am I to judge? They're also levering it up quite a bit. So some things we're doing. We're buying in-place cash flow, number one. I mean, there's nothing wrong with development. Developers make really, really good money. People who buy extreme value add, you can add tons of value. I'm not poo-pooing on that at all. But at our point in the cycle, where our net worths are, what we have to lose, I'd rather not risk a speculative investment of adding a ton of value to a property. That's risk, right? So we're buying in-place cash flow. We need our debt yield, which is net operating income divided by the amount of debt we have. How much net operating income is the debt generating? We have a debt yield year one over 9% on every single deal that we buy. 9% meaning we can take a 7% interest rate with principal and interest payments on a 25-year AM, and we're still going to break even. We're not going to actually lose money on a monthly basis. So we're not speculating on year three pro forma cash flows to make our money, because that's how, in my opinion, you can go belly up. And if you look at the deals that we bought, our portfolio-wide debt yield is over 15%, meaning interest rates on all of my self-storage could go up to about 13%. Interest rates 13%, principal and interest, and we're about break even on cash flow. I'm proud of that. Another thing inside of my private equity company, this is underrated. Inside of my real estate private equity company, we charge market fees. We're not on this low cost, low fee structure so that we can get more of the promote, and we're taking a ton of risk from our perspective and got all of our money tied up in the deal so that if we sell it or when we sell it, we can make a bunch of money. We charge fees. We charge an asset management fee every year. We charge a management fee to manage the actual building, equivalent to about 8% of the portfolio revenue. These little fees allow us to not do anything and our team can still eat. We can still make payroll even if we're not doing deals. That allows me and my team to weather a downturn. If we can't do deals, if we're tight on cash, whatever it might be, we have income coming in to support us, our families, and our team. We can keep our team intact. Another thing, we're not dependent on a sale. We underwrite selling our assets because we have to, but we go into every single deal talking to our investors, talking to our bankers, structuring our deal so that we can hold it for 10 years. 10 years, no sale. That's the base case. That's what's expected. So we're fine to hold it. We're fine to cash flow it. And so is our investment team. We have really low leverage. Now, this cuts both ways. We have really two things. The market's a little bit frothy. We feel like we're taking a little bit of risk getting outside of our comfort zone, paying up for assets. So we've reduced our leverage from 75 or 80% in the past down to 60%. 60% leverage, it turns out to be about 50 or 55% loan to cost, meaning our all-in cost after our CapEx and our onboarding fees and so on, and the closing costs and everything along those lines. The thing about leverage, if you lever up an asset to 80%, it's going to maximize, it's going to amplify whatever happens. If it goes really well, it's going to amplify the gains. If it goes really well, you're going to do great. If it goes poorly, it's going to amplify the pain. Amplify the gain, amplify the pain. That's what leverage does. So you reduce that leverage, and okay, yeah, you put a damper on the potential gain. Our first year cash on cash drops from 9% to 7.5%, maybe 6% even on some deals. But it's all about risk-adjusted return. What's the risk that you took to get those gains? Not enough people in real estate think about that. How much risk did I take to get these gains? That is very, very, very important. So if you're doing a new development that's levered up to 75%, that you got to raise rents, you got to build this building, you got to take all this risk, you got to lease it up, and you're projecting a 15% IRR, holy cow, is that a good risk-adjusted return? Heck no. But if you're buying an in-place, full self-storage facility with 60% leverage, a lot of equity, and that's a projected 15% IRR, okay, I feel a little bit better about that. So if you value our entire portfolio at a 5.75 cap, which if we sold it, put it on the market right now, it would sell for 4.75, even though they're tertiary markets. The market's crazy. But if you take a conservative 5.75% cap rate valuation, our portfolio is less than 40% leveraged right now. And it has a 15.4% debt yield. I'm proud of that. We have $28 million in debt on our current assets. We have $4.36 million in net operating income right now on the books right now. So 4,369,000. We have $4.3 million. If you divide that by 0.0575, it's $75 million of assets. So we have $75 million worth of storage, and we have $28 million of debt. 28 divided by 75, we are 37% leveraged. 37% leveraged right now. I like that. I like that we're not over leveraged. Even though we have a ton of equity tied up, that equity has opportunity cost. We should do some refis. We're going to do some. We're going to responsibly increase that leverage. But this is all variable rate debt right now. We don't have any CMBS fixed 10-year term debt. So those are some things that we have to think about. It's not as simple. And the last thing I'll tell you is that there's one golden rule in real estate investing. And if you break the rule, it's game over. You lose. There's no going back. You're going to lose everything. And that is, do not run out of cash. If you run out of cash in this business, or cash flow, if you run out of cash in this business, it's game over. It's done. The bank will take everything from you. I am personally guaranteed all of that $28 million in debt. So if I can't make that payment, this house that I'm recording this video in, that my two kids sleep in upstairs, that my wife and I eat every single day, this house right here will be gone to the bank if we run out of cash. So while you always hear the term asset rich, cash poor from a real estate investor, well, you kind of want to have some cash on hand. God forbid something happens, you need a little bit of cash. What are you going to do? So we keep an uncomfortable amount of cash in reserve. It's over 7 figures, actually over $2 million in liquidity right now that we have at our fingertips in a heartbeat in case we need it. We can cover debt service. We can hop on new deals. We can cover surprise expenses, whatever it might be, without running out of cash and it being game over. So these are rules. And again, not every real estate investor is going to be able to do this because it's really hard work. We've done a lot of good operations and we bought at the right time to have some of our assets in a great situation. But managing risk is really important. So people can tell me all day that, hey, Nick, you don't know what it's like. Your generation, you guys think real estate prices only go up forever. you're wrong. And yeah, you're right. I know real estate prices don't go up forever. We're doing a lot of things to manage risk in our portfolio. And you should think about these things if you're making an investment with a sponsor, and you should think about these things if you are doing your own real estate deals. Juniper Square, the sponsor of our show, recently did a capital raising survey. And in this survey, they asked 142 senior executives at US-based commercial real estate firms a series of questions to understand the state of commercial real estate fundraising. It's an insanely valuable report with data on questions like, how much capital did you raise last year? How long did your last raise take? What type of investors are you raising the most from? And what strategies are working the best for you to find new investors? Download this report for free at junipersquareresearch.com. That's junipersquareresearch.com. Big thank you to Juniper Square for sponsoring the show. Thank you for listening to the Nick Huber Show. Just wanted to remind you that we have a paid real estate community where some really special stuff is happening. People are breaking down deals. People are networking. People are, I think, even formulating partnerships inside this group. We have over 100 members now. For more information, you can visit sweatystartup.com/REC. And the first 299 members of the group to get some momentum get $200 off the annual membership using the code FIRST299, FIRST 299. And also, you can check it out for 5 days for $1. You make a $1 payment, you can check out the community for 5 days. Highly recommend it if you're serious about bringing in some other people into your network, into your life, to help you become a better real estate investor.